Good morning and welcome to Bazaar Ki Baat. In the month of May, the Indian markets continued to do well, and the mid and small cap sectors did even better. The S&P BSE Mid Cap Index surged around 6.4%, and the S&P BSE Small Cap Index surged 5.6%. We saw quite a bit of upside in Nasdaq as well, with the tech stocks outperforming, but the US markets continued to remain uncertain, grappling with persistent inflation and investors struggling to anticipate the impact of Fed's rate hike trajectory and the federal debt ceiling debates. Kshitij, welcome to Bazaar Ki Baat and good morning. What is your take on the market update overall?
Good morning. Yeah, so Shruti, I think as you have covered rightly, it was a broad-based rally in May, and the broad-based rally means that the retail investors would be a happier lot, as most of the retail portfolios have a mid-cap and small cap tilt. So they must be seeing green now. The other thing is that the story remains same as per last month. It is on the back of FPI buying. The FPI investors pumped in around 48,000 crores in Indian equities in May, which is the highest in almost 9 months. This is largely on the back of strong fundamentals for India, as it continues to be the high growth country and portrays stable macros. There have been a recent Morgan Stanley report that has been well covered in the media, which highlights few points, few transformational changes actually in the last decade that will set India apart in future. Which of one of some of them caught my radar. So I will probably like to speak about them. That one obviously the largest change in my view is that the corporate tax reduction. So this actually makes all our companies at par with their peers, though there is still scope to reduce to make it more competitive. But any reduction in corporate tax suddenly improves ROE of companies, and they can compete much better with their external peers. Infrastructure building, I think that is this we have to give to this government. I think the large infrastructure building has been done: highways, renewable energy capacity, railway route electrification, you name it, and they have done it. The other big change which has come, not even in this government, I think it started much before that, is the IBC code, which led to this continuous fall in NPAs over the last decade. And we've also seen the deleveraging cycle, largely on account of the fear that the promoter has now that he may lose the company if the debt is not served. The fourth one, which is I think the one of the important institutional change, is the flexible inflation targeting, right? It just showcases the government and the institution, RBI and institutions focus on inflation. And it kind of anchors the inflation expectation, which plays a big role in the, so inflation expectations play a big role in how the inflation actually comes out. Just to give an example, let's say if you and me are going to decide a price for our product in the next year, if we believe the inflation is 10%, we will be mostly likely to increase our prices by 10%. So inflation expectations play a big role in deciding what the inflation will be in the future. So anchoring those are very important for our economy. And something from our industry, which we have been talking about, is that the India is having its own 401k movement, like in US. The retail participation has been growing with SIP contributions touching 13,000, 14,000 crores per month in mutual funds. I think this is the biggest change, and we have seen this. This has been the reason we have seen we've not seen sharper falls this time when the correction happened after the war. So in all sense, I think the India remains the market for the future. There is a simple math behind it. If the India grows at 5% of real GDP growth, and the inflation expectation is around, let's say, 4 to 5%, or even at 6%, the nominal GDP will grow at 10 to 12%. And so you tell me, if we pick up reasonably well, or even if we don't pick up, we just invest in index, I think we are expected to grow at 10 to 12%. So if you give me a stock which is which can give me a stability of 10 to 12% growth year over year, I think the valuations will be at a premium because markets reward certainty. So it's no brainer that India is at a higher premium than its EM peers because we provide a kind of a macro stability and growth stability to the investors. So I think we it deserves the valuation premium what India market has. So that's about it.
Yeah, so thank you for that perspective, Kshitij. I think a lot of people talk about overvaluation, and I think the math that you just explained clears that out. That there are a lot of fundamental strength areas that India exhibits, and because of which that valuation is well justified, and the current valuations can be called reasonable. When I was looking at the sectoral performances, we have seen a divergence for the last few months. In the month of May, realty, IT, FMCG, auto, all of these have outperformed. Metal, oil, and gas have been the underperformers. Interestingly, in the factor universe, the momentum strategy as a factor has been doing really well for the last 2 months. What's your take on the sectoral diversion of performance?
Uh, Among the major gainers in the last 12 months has been industrials, capital goods, FMCG, and auto. I think these are largely the cyclical sectors, and they are expected to do well once value strategy starts doing well. So, as these sectors were out of turn for some time, the valuations had become attractive. So that is the reason which we believe that these sectors are doing well. These are cyclical sectors, no doubt. Autos have been doing well on the back of strong growth numbers from a lower base, albeit, but still they've been showing good persistent growth. Metals and oil seems to be underperforming. Largely, this is all earnings driven. So you cannot, in any market, you cannot escape how the earnings are doing and how the stock is doing. It may be uh, disconnected for a while, but not beyond that. So yeah, you can probably look at how the India Inc. fared in Q4 going forward. So that is the
Yeah, right.
idea.
So let's move on to the earnings profile of the industry. Would you want to take us through this slide where you have looked at industry specific earnings growth, profit growth, sales growth, and tell us how this ties in with the sectoral performances that we are seeing?
Yeah, so I think India in profitability remained healthy in fourth quarter. Excluding financials, profits for Nifty constituted grew at around 7%. And Nifty EBITDA margins ex financials is also contracted, right? So there is some margin pressure, no doubt. But there's been healthy growth at least for profits till now. The corporate earnings largely have been driven by financials and auto, while metals dragged corp aggregate profitability. Gross margins for, like I said, some sectors have been facing margin pressures, the cement, logistics, retail. They had a contraction of margin, while healthcare, consumer, real estate has been doing very well. Automobile saw good margin, especially as you can see daily there will be some article in the newspaper saying that I think highest numbers clocked and sharp growth. So auto as a sector has been doing well. Large software companies saw drawdown. But some of the points which I would like to cover is that we see that aviation has done well. If you see the chart, you see aviation has done well. This is largely due to the uh, Indigo Airlines coming back to profits, right? They had a very after making losses in FY22 and in I think due to the COVID impact and the high cost of fuel, we are seeing airlines coming back into profits. So that is the reason why we see aviation doing so well in the chart. Hospitality that has been on a tear. We all know there has been revenge travel. Hotels have generated strong results, especially if this is largely contributed by the largest hotel chain, which is the Indian Hotels, which saw almost a 250% net profit growth in FY23. Insurance, this again is driven by LIC results. LIC saw 450% profit growth. as compared to last FY, right? There have been some reasons, for technical reasons for it, but still any profit is good profit. That's about it. We are seeing IT companies having mixed performance. We saw the larger companies not doing so well. We see tier two kind of companies doing well compared to their larger peers. Banks, as always, are doing well with a healthy loan growth. Margins have been stable. I think there's all around growth in banks, be it PSU or private. There are numerous drivers of rate expansion. As we saw that there's been a deleveraging in corporates in the last decade or so. Now, if there is a pickup in demand or credit demand from corporates, I think banks are expected to do well. So yeah.
So you mentioned that financials have been driving largely the sales and the earnings growth, and I would want to look at this chart that shows a couple of different kind of insights can be drawn out of this. Do you want to take us through this with specific focus on how is the financial sector being able to really deliver consistent performance?
Yeah, so if you look at this chart, so I kind of found this chart from Villa research, and which kind of drew me towards it. That it kind of brings out some certain simple facts, which is driving the market. Obviously, we can see the rise of the banking sector in the Nifty 50 constituents. The profit growth of Nifty 50 banking companies has grown from 896 to 218, almost 2.5 to 2.33 times growth from FY20 to FY23, and it contributes now close to 34% of Nifty corporate earnings. So the banks have been doing really well. They have shown stable growth of almost 30-40% year over year for a while now. Oil and gas, this continues to be a large sector, and there will be large companies there, but we are seeing earnings slow down. Cyclicity of certain sectors we can talk about. Let's see, automobiles, if you see, they show good profit growth in 1 year, then a drop, and then a good profit growth. Metals, we saw sharp highs and then lows again. So oil and gas, for example, these are the prime examples of how this chart beautifully showcases that there is a cyclicity in certain sectors, especially you can see it kind of brings out for metals, right? So you have to be very careful while picking up or investing in those stocks that the low P at times does not reflect cheap stock. Sometimes what happens is that you may be buying it at the peak of its earnings cycle, right? So the low P sometimes may be a trap in cyclical sectors. Defensive sectors, if you want to talk about, let's say consumer technology, you can see there is stable growth, but they're given year or over year they've grown and have been able to grow their earnings. So these are the defensive sectors. They do not go out of fashion. Every year you will find certain companies doing well. Telecom, I think you can see that it's been a loss-making sector for a while now, and now that we have clearly identified that there'll be a oligopoly structure present in this sector, in the sense with Jio and Airtel and other players losing out. We see that telecom is now slowly coming out of that price war, which was started by Zero, and the margins are improving and profitability is coming back. So we have to wait and see if there is no further war or price war or anything undue from the government side, which impacts the sector. But yeah, I think for now, I think we are seeing it going back to green, right?
Interesting. So one thing that comes out very clearly from this is that consistency is definitely rewarded by market, and we are seeing that in the way financials have been performing. Thank you so much, Kshitij. That was extremely insightful. Today, we are also going to
Thank you.
talk about a topic which has been on minds of a lot of people we have been talking to. Recently, there was a prospect which reached out to us, and while we were discussing insurance and specifically life insurance, there was a big question that was posed to us that why not take a whole life policy or a 100-year policy or an 85-year policy, why do we as a team strongly recommend taking a term plan which is limited till the age of, let's say, 60, 65? I would like to bring in Vikas here. Vikas, good morning, and would love to hear your thoughts. You've done some analysis here, and I would love to hear your thoughts in terms of why do you think that it could be better to take a term plan which is limited up to the age of 60, 65, which is typically the age of financial independence or retirement, as you may call it, as opposed to a policy of 80, 85 years or even 100 years.
Hi, Shruti. First, I would like to talk about term insurance general, which is very basic. A lot of people may know, but still, term insurance as a product is to hedge your risk. So what happens is that I also come from a typical middle class Indian background where we used to think that if I'm paying something for insurance, I should get something in return. And I can never think that I am paying for insurance as an expense. So I see a lot of people who come from a similar kind of background think that if I'm paying something, I should get in return. So first we have to get out of this mindset and we have to understand that the purpose of term insurance is not to give you back something after a period of time, but to protect you from a emergency which can be only met through a term insurance, because in other insurance products you pay such a high premium that you can never cover your risk, so you will always be underinsured. So once you start differentiating between a term insurance and like hybrid policy, that is the first step towards thinking that why you should buy a shorter time frame term insurance. So what happened is, for me, when I was also taking my insurance, I was always keen that I should like buy for the maximum possible age so that whatever I'm paying, I get something back in return. But then I read more, and then talking to people in the industry, I realized that the purpose of this term insurance is to hedge my risk. And if I have to spend that money, I have to understand first that what is my term insurance cover, which I require. So if I do a small back of the envelope calculation, what I think is that if you are having whatever expense, if you take 30x that expense, you are able to cover your family for in case of any emergency or if something happens to the earning member. So for my case, what I did is I did some number crunching. If I buy a policy for 1 crore, my age is 35. If you are a non-smoker, if you buy a policy for 1 crore, you have to shell out 16,388 rupees as premium if you're covering yourself till the age of 60. But if you cover yourself till the age of 85, you have to shell out 29,102 per year. So now what happens is that just to like cover from 60 to 85, you are paying 13,000 rupees per year more approximately for the entire period up to the age of 85. So this is first trade-off that you have to do if you're buying a higher like period term insurance. So one thing this you have to keep in mind. Now what happens is that at this point, if you have enough, if you want to spend enough on term insurance, then this becomes a no-brainer. So if you are okay paying 30,000 and you can take any sum assured that you want, then it is okay. But if you have to do a trade-off, if you see what happens is that, can you go to the next slide? If you are paying, if you're paying till the age of 60, you are covered till the age of 60, and after that, you don't have that sum assured of 1 crore. But the premium that you have saved, that is invested. That what we have assumed is that you invest it at a nominal rate of 10%. And if you invest it at a nominal rate of 10%, at the age of 60, you will have 14 lakhs of capital. And if you see that if every year, if that premium is saved beyond 60, you now start saving 29,102. And by the age of 85, you would have a higher amount than what you would have through the sum assured if you would have taken that 85-year term policy. The only gap is between the age of 80 to 85. There is some gap between the sum assured, but the thought process over here is that if you are an earning professional, by the age of 60, you would have already have adequate financial capital to hedge this risk. And you may not be dependent on this term insurance. A lot of professionals I see, what they do is even they take a policy till 60 years, but at the age of 50, 52, 50, 52, 53 only, once they have that financial capital ready with them, they stop paying this term insurance. So going for a lower term insurance has these benefits. So some of the benefits that I have listed out is that first, you are spending on a product more than what is required. So insurance, term insurance is not a saving product, it's an expense. So what happens is if you are paying a higher premium, you are spending higher for a product which may not be serving any purpose for you. So this is first thought process. Second is that if you save that additional amount and if you invest that additional amount in a growth asset, what happens is that after the age of 80, the asset is outgrows your sum assured. And after 85, the saved capital will still be available to you, but in a term insurance, after 85, that sum assured is also not available. The third benefit is that the additional amount that you have saved is available to you after 60 in case you need it for any medical expense or anything. So this saved capital is available to you and you can spend it. But in the other case, it is only available to your legal heir. The advantages of a higher term policy, which I can think, is that it gives you psychological comfort that yeah, something will come to me or my legal heir predominantly whenever something happens to the earning member, even if it is at the age of 84, 85. And second is that you get a higher coverage till 84, 85 you are covered. So these are the two benefits of taking a higher policy. So you have to think through before buying a term insurance for 60 or to 85. My personal recommendation is that it is a product which helps you hedge your risk. So it is better if you buy it till the time you are having that risk. So in the early years from 35 to 45, you are having a higher risk because your family is entirely dependent on you. So taking a higher cover is more advisable rather than spending on a higher term policy. So this is my view, and we can talk more about it in the upcoming sessions.
Right. So, because I kind of agree with you, even in my experience, I feel that there are several benefits of not taking a higher period term plan. It's only a psychological comfort, but in most cases, if people have been managing money in a more disciplined manner, they're likely to be financially independent between 60 to 70 for sure. And once you're financially independent, there is absolutely no need for a term plan to take care of any of your financial goals. And I think one interesting point that you really made is that if somebody is investing this premium that they are saving by taking a lower period policy, that capital is always available, right, for any emergencies. And in fact, if the assumption is that we'll live up to 80, 85, that even outgrows the capital that the term plan would have anyways given to us. And post 85, obviously there are no payouts in a term plan. So I think that's an interesting point, but I think we need to continue this discussion in the next month's call, because we need to talk about two more important things. Number one is, how do you really ascertain the adequacy of your term cover? How much term cover should you normally have? This is very pertinent because a lot of people we meet have hybrid insurance products which are grossly inadequate for covering their liabilities or responsibilities in an event of an untimely death. And the second thing that we can talk about is limited pay policies. That's also become very popular in the recent times. And a lot of people come to us asking, should I just take a policy where I pay a premium till 10 years and then I don't have to pay a premium on an absolute number, I'll be paying a lower premium. So these are two topics that we will be touching upon in the coming episodes. Stay tuned and thank you for watching.